Derivatives overall, huge growth. It's, from maybe 1980, 1985 to 2007, it was just exponential growth. We've had a little bit of retreating in the past few years, although actually people don't really know specifics on the amount of derivatives outstanding. But so OTC is over the counter, so it's sort of unofficial, or this is derivatives that don't necessarily go through measured groups that can quantify. But guess how much we think is outstanding in terms of derivatives, in terms of money in US dollars right now? And this is, yeah, I think the best I could get is something like 600 or 700 trillion. Yeah, exactly. So it's just, unimaginable amounts of money are wrapped up in these things, and we still don't really have a good sense of them. And a lot of people are arguing that we should have a better sense, and saying we need to, have people who are facilitating the transactions so we know what's going on. But that hasn't happened yet. Let's just start with the basic one. So I will get to that. And you all might have seen something like this, right? This is a Wall Street Journal graphic. So, and this is kind of the most obvious use for a derivative. So a farmer sells a futures contract to lock in a price for the crop at $3 a bushel. So if the price goes down before the harvest, the farmer sells the corn at the lower amount, but then makes up the difference through the hedge. So you can buy the new futures contract at the lower price, and then minus after paying the transaction fees on the future, he'll actually hit the target of the $3 price. So even if the price goes down, he's still protected because he bought the derivative. If the price goes up, the farmer has to pay the margin call to a broker to keep the position, but then sells the crop at a higher price, but then has to take the loss to meet the futures contract. So the farmer doesn't get those gains, but is also protected against the losses. So a farmer has to look at the crop and say, basically it's good for budgeting, right? A farmer can say, I am pretty sure I can get $3 a bushel for this. This is a safe in-between. And, you miss out on the upside, but you're protected from the downside. So that's kind of the generic way of using the contract. Options, a future is that you lock in something at a certain price at a certain time. And so that's an obligation. The option is that you have the choice of buying that at the future time. So, I'll talk about this a little later, but if you have an option on Apple shares that expires in a month, you have the choice of enacting that option. You don't have to act on it if you don't want to. Whereas with a future, you are locked in to buying the product at the certain price. So the future is more certain, the option is less certain, or the option gives you an option. And let's see, and the other one, you were asking about the swaps. Okay, the swaps are, I guess I'll hold off on that. Okay. So, and this is a swap. So you have, this is Bank A, which is trying to, it wants to insure against the default of something, like a company here. So Bank B is insuring that bank against this company's default. And this one gives it payments. And then if there is default, by some prearranged thing, like if this company declares bankruptcy or something like that, Bank B will pay the bank that got the insurance for the amount of the loan or an amount agreed upon. So basically, this party that isn't related to this bank is insuring this bank against the default of this. So it's almost like insurance from the outside. So that's a credit default swap. And so, I mean, in a way, it's pretty straightforward, but a lot of the problem has come as people have kind of gotten complicated with them. And we'll get into that in a second. I mean, and the other thing is that, you know, if these companies aren't that likely to default, you know, you look at the risk and you say, okay, this is not such a big deal. But if, as it gets more likely, it becomes a problem. And for instance, with the United States housing crisis, some of this was that everyone was looking at mortgages and saying, most people don't default on their mortgages. So this is a pretty safe bet. But the problem is, so many people were betting on it that banks were facilitating more and more mortgages to people who couldn't really pay. And so it ended up becoming much riskier than people had figured into their models, right? Models can be a dangerous thing. And then we had a lot of defaults. With something like a derivative, like a credit default swap, you have the contract, and then you'll have the trigger, which is something like a bankruptcy or a non-payment of a loan or something like that, and then you have a payment. So that's okay. And so this is a quote from a good friend's article in the Wall Street Journal. So, and I'll just read it because it's, beginning in the mid-1990s, the evolution of subprime lending, and subprime is where you give to borrowers who are riskier, who are less able to pay, or less likely to pay their loans. So the evolution of subprime lending from a local niche business to a global market drastically rearranged lenders' incentives. Instead of putting their own money at risk, mortgage lenders began reselling loans at a profit to Wall Street banks. The bankers, in turn, transformed a large chunk of the subprime loans into highly rated securities, which attracted investors from all over the world by paying a better return than other securities with the same rating. The investors cared much more about the broader qualities of the securities, things like the average credit score and overall geographic distribution, than exactly where and to whom the loans were being made. So some of this is that basically people lost track of what was going on, right? They were trying to get higher returns, better return than other securities with the same rating, and they didn't know what to do. And actually, one of the funniest side effects of this is that people, when banks are foreclosing on homes, you know, foreclosure, they're trying to take the house away from someone. When banks in the U.S. are foreclosing on people and trying to get them out, people are starting to win their cases because they're saying, you can't prove that you actually own my home because all these things have been sliced up so much and put into all these different crazy boxes that nobody owns the home in a way. So some judges have been saying, you can't do this. This person gets to stay in their house. So, you know, it's been a headache for banks, to say the least. You know, even though we already had the derivatives crisis and people thought a lot of this might be over, there are still a lot of problems out there. And did you all hear about the London whale? Okay. So basically, this trader at JP Morgan, you know, was buying up huge positions in the credit derivative index market. You know, the market's about 10 trillion, and he was buying positions in indexes that were rising or falling based on what people thought the likelihood was of companies defaulting. So it wasn't even betting on the credit default swaps themselves, it was betting on indexes of them. So, again, this is getting to the second layer removed from the actual thing. And, and ICSL worked in the chief investment office, which was kind of this vague thing that they had where, they would just store some money as people brought the money in, as customers invested money before it went out to other places, they would put it there. But, it had $4.14 billion in revenue in 2011, and that includes treasury and private equity, but, quite a lot of revenue. What ended up happening was that he was getting so big that he was moving this market himself, a $10 trillion market. He was going in there and investing, trying to buy into certain positions. But a big part of the problem was that it's not a liquid market. Have you all talked about liquidity? Yeah. Okay. So, if tons of people are going in there and buying and selling, it's one thing. If you have, a couple people trading a week, a couple people trading a day, one person comes in and says, I want to buy this for this price, and it can really change things around. So other people in the market started noticing this and getting upset about it, and actually complained to the media. We're saying, and this was all, it wasn't really in the open, but people were saying, we've noticed these indexes moving a lot when we are told he's in the market. So it wasn't ever, I see this guy and he is, and we're dealing with each other and he's moving the market, but it was, we're told that. So people actually, other people in the market started talking to Bloomberg and the Wall Street Journal. We actually had a big race to get there first to report on it. But eventually, people started betting against ICSL because they realized he had such big positions, and it blew up. And unwinding those trades cost JP Morgan $6 billion. So even last year, it's still a big thing for companies that they don't necessarily realize. And of course, even the head of the chief investment office said, well, she didn't really know what was going on in London. She was in New York. There's a big ocean between them. She couldn't tell. How much do you know about options? Do you know puts, calls, that stuff, or not really? Okay. Just go through that kind of quickly. So, when you have an option is exactly what it says. You have the option to buy a security buy or sell a security at a set time in the future. A put is an option to sell. So it's basically, it's usually used as a bet that the price of something will fall. So, you have a stock that's at $50 and you think it's going down to 40. So you will buy a put, and then you'll have a chance to sell that stock at the higher price, even when it moves to a lower price, and make money off that. A call is a bet that the price is going to rise. So you will profit if the price goes up instead, and you have the option to buy the stock at $50 when, say, it's gone to $60. So, and there are lots of ways you can change this stuff around, but that's basically what it is. A put is kind of a negative bet. A call is a positive bet. Expiration is just when it expires. So for forex options especially, they expire every day. The forex market is huge. It's very liquid. It's very tough to move it. People think George Soros moved it betting against the pound in, I guess, the 80s, but mostly it's moved only by the biggest government data announcements and really big things. So the spot price is the price of whatever it is. So the price of the stock at the current time, so $50, say. And the strike price is the price at which the option is triggered. So if you have a $40 put, that's the strike price. You have a $60 call, that's the strike price. And then the premium is what you pay for that option in order to, it's basically the cost of the product. So, okay. These have grown a lot in recent years in a lot of places, especially, the US, Europe. It's funny, Australia has actually had a decrease in it because people got so risk averse. So, I mean, there are markets here and there where it's gone down, but mostly it's gone up. And you can, if you feel like you know a lot about whatever security it is, you can make a lot of money on it. And with the leverage too, you can, with a stock, if it goes from $50 to $60, that's a 20% gain. But with the option, if you invest at the right time, you can make, you can have 5 times your money or 10 times very quickly. So, because, the price of that option contract will go from 5 cents to 50 cents, say. Okay, so this is, it's kind of out of focus. This is, sorry, but you can see generally. This is a call option on Apple shares. This is a Bloomberg terminal screen, so I just kind of pasted some of this stuff. So with the call option, it's at $470. So the call costs $2.12, and the price of the stock I think was at $4.50 or $4.55 at the time. But so with a $470 call option that costs $2.12, you won't make anything until you get to $470 plus your $2.12 fee for it. So at $472.12, you start to make more and more and more. So that's when you get to the profit. And then with a put, this is a $430 put. Cost is $1.83. And so you don't make anything until you get to $428.17, and then your profit goes up from there. And so you can do sort of other more complicated things, and this is when people start to play around. So if you buy both that $430 put and that $470 call, you make money on either end. You pay a little bit more here, so it takes you longer. But this, for instance, would be a bet that the price is going to move a lot in one direction or another. So a lot of people will do this, for instance, for a drug company. Small drug company, one drug out there, a study's coming up that's going to say whether this drug company is succeeding. You think this is either going to send the shares up a lot or down if it works, or down a lot if it doesn't work. So I'm going to do something like this and bet that the shares are going to move one direction or the other. So, a lot of the financial professionals decide, just investing in the stock, long or short, isn't enough, and do something like this. And they do all sorts of crazy patterns. You can make it the other way where you sell that put and that call and make a bet that the stock isn't going to move. You can also do things where you just buy options in order to get the dividends. So a lot of people do that too. You can sell a call above the share price, just if you think that the price is pretty high and you want to keep owning the stock, but you don't think it's going to gain a lot in the future, so you're still able to get the money from selling. So I know this is kind of getting into mechanics of stuff, but does that make sense to people? Do you guys have questions on that? So, but you can see where, there's definitely a lot of the leverage in terms of making money, and kind of dealing with things just beyond the share price. So a lot of people who think they know what's going on with the stock and have the money to do it have been using options to do things. The VIX is was the original one of these. It's based on options prices on the S&P 500 index in the US. And basically it looks at how much people are willing to pay for options on stocks in the S&P 500. And then says, okay, the more they're willing to pay for put options, the more fear there is in the market. And so it's basically a measure of how peaceful or how not peaceful the market is. And the VIX is owned by the Chicago Board Options Exchange, or CBOE, which is a U.S. company based in Chicago. And since then, they've done a lot of other indexes. So you have the V stocks for the Euro Stoxx 50. That's the main one in Europe. You also have the India VIX. You have Australia, Hong Kong. So a lot of ones around the world. I don't believe there is one for Ukraine yet, but maybe you'll get it at some point. You can always ask. And this has been used a lot more post-financial crisis as an investment because people now know they need to be hedging. And so they'll do something like they'll invest in the S&P 500, but then they'll also buy a call option on the VIX. So that will mean that they have their investment in stocks, but if the VIX jumps, and because people are afraid, which usually means the market's going down, they have some level of insurance and they'll get something kind of to counteract any drops in the S&P 500. And I mean, it really is soaring. The VIX future story was not anything that's a brilliant piece of journalism or that you have to go in depth into, but it's just showing that it's really soaring as an investment. And actually, yesterday, CBOE came out with the volume figures, and it's up something like 53% year over year. So it's definitely becoming more of a thing. And just to illustrate, again, this isn't, I know it's a little bit hard to see. This is for the V stocks index. So that's the white, and the orange is the Euro Stoxx 50. So they basically move the opposite directions of each other. And you can tell, ignore this, I couldn't get it to drop off. But the correlation is minus 0.8. So that means they move in opposite directions about 80% of the time. So, it's when they don't move in opposite directions, it can often be a sign of smaller things in the market, and so that's sort of interesting. But in general, the main thing with the VIX type indexes is that people are using them a lot as a hedge.